Hey, good evening, everyone, and welcome to tonight's. Tonight, we're actually going to talk about how markets react to war. When I was thinking about what I was going to talk about tonight, there's so many things that I know you would really appreciate me going over, whether it's about life insurance or especially now we're in RSP season, everyone's beginning to file their income tax and want to make RSP contributions. Talking about RSP some more might be useful. But given the state of the market, I've always found over the 20 plus years of doing financial planning and helping clients achieve their goals, I've always found the most valuable time that the relationship you have with an advisor is most important. And by the way, if you can hear me, great. Please give me a thumbs up or a like or something so that I can make sure that I know that you are hearing me just fine. But what's important today is to really focus on, I think, is especially in markets like now, and that is understanding the relationship of how you can actually feel calmer and more at peace, less anxiety around investing. Because with markets the way they are today, this is the time where you're feeling probably most vulnerable, probably the greatest amount of anxiety around your portfolios. And so this is, I think, probably the most important, use of my time tonight. Thanks, Pascal. Great to see you on the call. So again, tonight is going to be talking about, I think the best thing here is helping you to see sort of through the fog of all the noise of the CNN, Fox News, CBC, newspapers, what you're hearing a lot of people talking about, and you hear their anxiety around it. Hi, Ivan, nice to see you on the call. And so I think tonight is just the right timing to give you some information about how I see the markets and how I help clients through these times. And I mean, the most important thing when you're working with advisors is for them to give you information so you can make better, more informed decision. And if it's just, you talk to an advisor during a portfolio review and then you see them or talk to them 6 months later, that's a disservice, right? That's not really helping you. So you really want to be on the phone or at least hear from your advisor during these times. So I'm going to dig right into it right now and help you. And if you have any questions while we're doing this, please put your questions below. I'm happy to talk to you and answer your questions on the fly as we go through this. It won't be a long video. Like before, I said 15 minutes and it was 30 minutes, but we'll dig into this. I'm pretty sure we can do it in 15 minutes. If you're new to this channel, my name is David Aaron, and I provide financial planning, retirement planning, estate planning. I manage money. I do life insurance, group plans, all these things. So I'm an active advisor. I'm not just someone making videos. I'm both, right? So let's dig into this right away. And thank you so much for giving me your time. So the first thing I want to talk to you about is this right here, and that is the retirement zone. If you're retiring within 5 years, or you're already in retirement in the first 5 years of retirement, this is the most critical phase of your retirement. And the reason for that is because you really don't want to experience any prolonged negative returns, because this is the time that you're going to start to do withdrawals on your portfolio. And you really don't want to do withdrawals during a prolonged negative period, because it really accelerates the declining balance in your portfolio, right? Your portfolio is going down and you're withdrawing, so it accelerates that momentum. So you want to make sure that you don't have a portfolio that is really declining too severely. I'm going to get into that at the very end, but I'm going to share with you stick around. You're going to hear some very insightful things that I think might really help calm your nerves through all this. Okay, if you are starting the process, if you will, if you're not starting the process, but if you're in a position where you're trying to figure out, what am I doing? Where am I at with my financial planning? Where are we with our goals? And then you look at the markets today. If this is causing you to lose sleep, to have severe anxiety, you're really worried about what's going on in the markets, what's going to happen to my money, then maybe it's time for you to re-examine your risk tolerance. And so for those of you that don't understand or may have forgotten what a risk tolerance is, I'm going to share this slide with you. And this slide basically is, let me just get this graphic. This slide is these questions that you may have been asked. This is thanks to Royal Bank for letting us use your risk allocation questionnaire. So really what this is really doing is anytime you open up an account, you're being asked a number of questions. Do you remember that when you open your first account and they ask you, what's your age? What kind of an account is it? When do you plan to retire? How many more years? What would happen if the market declined by 5%? Would you sell? Would you keep your money where it is? Would you add to it? All these questions, there's usually a dozen or more questions, and it helps you to figure out what your risk profile is. And I'll show you this here. This is exactly what it means. So you may have heard of this. You may have heard very conservative investor, balanced, growth, and aggressive. Company over company have different types of naming this. You'll hear moderate investor, advanced. It just depends on what company is giving you the tool. But essentially what I want you to pay attention to is those pie charts. And you'll notice, let's start I won't go through all of them, but you'll get the idea as we do one. The top left-hand corner says very conservative investor. That dark blue area is fixed income portfolio. So bonds, GICs, for instance. This is very secure in the case of a GIC, guaranteed, but very secure, low return, low risk. And so if you're a very conservative investor, that slide or that pie chart would appeal to you because you're really looking for preservation of your capital with very little risk to your portfolio. You may want to just try to grow your money ahead of inflation. Kind of hard right now if you're a conservative investor because inflation's at 4% or higher, actually 5%. So, but that is very useful because in times like today, the market declining, times like the last 2 months, market declines really don't affect a conservative investor as it would if you go right down to the bottom left-hand corner, aggressive investor. Look at that. There's no blue area there. That person is swinging for home runs every single day. They have no fixed income. It's all equities, so stocks. And they're very different kinds of stocks, Canadian, US, international, but zero fixed income. So they want the maximum return possible they can in their portfolio, and they don't want any slow growth. They want to hit home runs every day. So you might see that for someone who is very young, who they have a lot of runway ahead of them. They are going to be working for a very long time, won't be going in retirement for a very long time, or don't need access to the capital they're investing for a very long time. So you can see the difference in terms of risk tolerances. This is something you should actually examine. Back in 2008, you remember the 2008 financial crisis, people were freaking out. It was a very stressful time. Everybody thought the world was coming to an end and their money was going to disappear. And we saw that over a period of time, the markets came back up again. But they probably hadn't re-examined their risk tolerance in a long time. And all of a sudden they realized, I'm not as aggressive as I used to be. And that just clobbered me. I need to think about how I examine my risk tolerance. So this is an important thing for you to go through. I want to share this with you. And I think it's important for you to sort of get a sense of these things repeat each other. This is headlines from 2014. So we had a market correction. So market correction is more than 10% back in 2014. And the headline here was, the market correction is in full swing. Don't do anything stupid. This is the point when many investors lose their nerve. Don't be one of them. And so that's tonight's theme, so to speak, is, I'm going to give you some really good detail about what happens in markets during times of war, geopolitical events, and what happens to the markets coming out of that. And so I think that'll help you to sort of decide what to do. So let's just look at, where are we today? This is closing values of, the yellow line is the S&P TSX, that's the Toronto market, down to just over 2%. The Dow Jones, that's that orange line, is about 8.55%. The S&P 500 down a little more than 11%. And the NASDAQ, which is a tech-heavy index, which is almost, just above 17% negative return. So that is where we ended today. This is where we came from. Here's a 3-year return. There's COVID-19 right in the middle of that chart, April or March, basically, of 2019. or sorry, 2020. And you see here the market running up, even though it was choppy, people were nervous, they were scared, we were going to run out of toilet paper. where can I get hand sanitizer? It was an awful time. People were, rightly so, they were upset. But look at where we come from. The 3-year return on all those indices that we just talked about, the NASDAQ, as of end of values today, the NASDAQ has a 92% rate of return, 3-year rate of return, a 52% in the S&P 500, a 29% in the S&P TSX, and a 28% in the Dow Jones. That's your 3-year return as of end of values today. I want to put that into perspective. You have all made a tremendous amount of money. I'm not discounting this. Please don't misinterpret what I mean by it's okay, the market declined, so what? You've made so much money. It's great the markets have run up, but I want you to put it into perspective that the markets have run up tremendously, and having a market decline from time to time is inevitable. But one thing it's almost impossible to get away from is a geopolitical event, and especially a sudden event versus one that has a pre-war kind of buildup. And I'm going to get specifically into what does that mean. So if we're looking at today where we've got Russia and Ukraine and the United States involved, and now a lot of other countries getting involved, that was a sort of a build-up to a potential war. We'll see if there's going to be one, versus something that happens like Iraq, that kind of Kuwait, those things where a war happened all of a sudden. There was the shock and awe that we saw in Afghanistan, Iraq, and so on. So I'm going to now share with you another slide. How are you doing so far? Do we have any questions? I'll just check to see if we have any questions, because I'm about to drop some good detail on you and you'll see what I'm talking about. Okay. This is some insightful news. Pay attention to this. Stop it, rewind it after I'm done, and reread this. In 2015, researchers at the Swiss Finance Institute looked at U.S. military conflicts, and we know the U.S. is now involved in Ukraine since World War II, and found that in cases when there is a pre-war phase, that's right now Ukraine, when an increase in the war is likelihood, this tends to decrease stock prices, exactly what's happening right now. But the ultimate outbreak of war increases them. However, in the cases when a war starts as a surprise, the outbreak of a war decreases stock prices. This phenomenon is called the war puzzle. So this is, I want you to, after I'm done this, if you need to rewind this and read it again, and then look at what's happening right now between Ukraine and Russia. This was rumbling, right? People were talking about this for months about what was going to happen, and debating and statements between all kinds of governments. If Russia does this, we're going to do that. So it was a pre-war workup to what could be a war, and that lends evidence to markets decline during this period. And now, sadly, one of the things I want to say is, sadly, I'm talking about what happens to market corrections or markets when war breaks out and people may be harmed. This is not what I'm trying to say of benefiting about this. I'm just trying to give you insightful information about what happens during times of war. So I'm going to share with you a number of slides, just I think 3 slides, to sort of illustrate how that works and sort of backing that up a little bit. Okay, you with me so far? All right. Here is the Gulf War, 1990 to 1991. I think it was only like 14 weeks or something. It was a very short-lived war. On the left side of the circle, that's Black Monday. That was like an economic crisis, a downturn in the market of about between 20 to 39%, depending on the indices. But it was like Black Monday. But the focus of this is really about, let's look at the Gulf War. Gulf War broke out, and immediately you'll see here that the market is declining, then kind of sideways a little bit, and then shoots right up like a rocket after that. People just got back to business. They understand there's a war going on, especially in North America. People are going, yeah, that's happening in the Middle East. It's got nothing to do with me. And the market's kind of run up. And I'm kind of like shrugging my shoulders. But honestly, people have a tendency to get worked up about something and then begin to live with it. Same as it's happening, COVID. It's not really a war. It's kind of a war on humanity, but we kind of got worked up, freaking out. Do you remember what it was like? The lineups at the grocery stores, everybody was rushing to get food, wondering what was going to happen, worried for our kids and for our family members. And everybody kind of like, okay, we know how to wash our hands. We know how to sanitize. We know how to get on with our lives. Same thing with war. Let's look at this here. This is the Iraq War, 2003 to 2011. And now this here, you can see the initial drop down, sideways movement, shot up like a rocket. So you can see how war initially, people kind of get nervous about it and then get on with their day. And then, of course, a worldwide financial crisis, nothing you can do about that. That was something that you could not step aside unless you were in cash and you saw that coming, and very few people saw that coming. I just have one question here. I'm going to see what that's all about. Yeah, Michael, it's a good question, Michael. I'll just show that real quick so everybody can see. Michael is saying, thanks for your question, by the way, Michael. Michael's saying, all this war noise will create some good blue chip dividend pairs, buying opportunities. So that is true. I'm going to not get into, not so much into, let me just see where this slide is. Hide, here we go. I'm not going to get into so much about day trading and stock picking. That's not what I'm about. I don't pick stocks for my clients anyway. I do all of my investing for clients through funds. And so picking out one out of thousands of companies is not something I can do with a fund. And I don't encourage people, unless you know how to trade stocks and you are comfortable putting all of your money to the line, if you will, so to speak, on that. That's your business and you go about doing it. But you've got to have a lot of time on your hands. You have to invest a lot of time and energy into learning how to do that. And I would prefer you to, if you're working for a living, I prefer you to hand that to a professional money manager and get on with your life and enjoy it. Okay, another slide. This is all of the minor skirmishes, bombings, all kinds of U.S. terrorist attack. 9/11 is in there. The Munich Olympics. So not just necessarily a war, but something that got the attention of the newspapers, got the attention of people all over the world. Pearl Harbor, you see how that is. So we're going back a number of years, and look at this is the S&P 500 index. And how did all of these unfortunate situations, how did that react in the market? So if you just take, for instance, 9/11, it's called U.S. terrorist attacks. You'll notice the one-day decline was negative 4.9%. The total drawdown was 11.6%. The bottom 11, the recovery 31. So we're talking about days, right? So it took 31 days to fully get out of that situation. And so when you think about what we're experiencing right now, and we'll just say the Iraq's invasion of Kuwait, let's take the next one, minus 1.1%, total drawdowns minus 16.9%, took 189 days to recover from that. So you can see what happens when there is a full blown out situation, especially in the Middle East, because the Middle East controls oil, oil controls the world. And so that kind of event can really upset economies all over the world. In this particular case, yes, Russia and Ukraine, there is some oil and gas on the table, but it is between really two countries. I think the total oil produced by these countries is 11% of the world's oil consumption. So it's not a significant amount, but it's not the end of, it won't create a crisis in the sense oil will go up, but it won't be the way it was when we had Kuwait. So one of the things I want to give you, and that is this here, and that is, I want you to remember to keep to your process and not get caught up in the headlines. If you're still working, you're 40, 50 years of age, you're still working, none of this is going to matter 20 years from now. It's going to be a blip on your total investment horizon, especially when you look at markets. If I go back to this first one here, this one here, this is back 1987 and it goes all the way forward to 1995. Look at the markets are decline and go up, decline and go up, decline and go up. The question is back to this point of view here, and that is, where are you in the timeline of needing access to your capital? That's really important for you to understand. Do I need all of my money right now, and especially in a place where the markets are declining, or do I need my money over 30 years? And do I need to be a little bit more conservative over the next 6 months? And I said in another video, if you recall, I said maybe for the next year, you do change your allocation to be a little bit more conservative, because we're in an interest rate hike environment. The 5 expected interest rate hikes, 1 probably coming in March, most likely, that you just change your allocation to accommodate a rising interest rate environment. Now you've got this geopolitical event, and there's no real way to pre-position your portfolio, because you never really know when a geopolitical event does or will happen. But here's what you can do. So you can write these down, screenshot it, rewind it, do what you want to do. But here is really where you want to be from a portfolio allocation point of view when you've got declining markets or you've got high volatility and you want a more defensive position. So you want the weighting of your money in your portfolio to be more heavily weighted to this: telecom, utilities, energy, healthcare, real estate. So when I say real estate, I don't necessarily mean buy actual physical real estate. It could mean that, depends on how much money you have, but it could mean real estate investment trusts, or it could be funds that invest in real estate investment trusts, financials, and consumer staples. Consumer staples like toilet paper, toothpaste, shampoo, right? Those are the places where you want to invest your money, because those are the areas that are considered more defensive in nature, as opposed to just companies that are more like IT right now. IT, as you saw in the first chart, if I go back to that here, the purple is the NASDAQ. Those are tech heavy, minus 17%. So those are some areas where you want to focus your attention. I'm going to leave it open to questions now, but I wanted to give you that insight. If there are any questions, let me know and I'll deal with them. But I wanted to give you that insight that what happens, there is actual statistical analysis about what happens to markets if it's a pre-warm up to a war, or if it's just a sudden war, what happens to markets. Right now, the Russia-Ukraine discussions is a pre-war workup, and they're saying it's imminent. So they've given us a lot of time to get ready for this. And so that tends to suggest, even though we have markets that are like this right now, it tends to suggest that the markets are going to go up if war breaks out. The markets will say, okay, finally, we know what's going on. There's a war going on. Everybody get back to investing, trading, and working, living your lives. And they understand how that works. Anyway, that's all I've got. I hope that was useful. Look at that, 23 minutes. I'm so stoked that I did it in a good way, in a fast way. I hope you got some insight. If you did get some value out of understanding that helps you to sort of calm your nerves in terms of what to expect over this short period of time, please let me know in the comments below. Share this video with anyone you feel needs to feel a little bit more confident about what's happening with the markets. And please follow and like the channel. This video will be uploaded to YouTube and edited so that you'll get some information. I always tell people at every single session, we take care of your wealth management so you can take care of what's most important to you. Firmly believe in that. Here's my contact information. I appreciate you spending time with me this evening, and I look forward to seeing you next Wednesday on our next live webinar, which is every Wednesday at 7 o'clock. Thanks very much, and take care.